Hello, I'm Jonathan Hall. That is Brian Grant, and we are financial advisors with Warburton Capital. And Brian, whether we are helping clients in the conference room or recording this podcast, our goal is the same: to help people have a plan for their wealth, determine a purpose for that wealth, and have that purpose move them towards peace. Today, we want to discuss a question that clients ask us all the time, particularly around investment strategy. Are dividend stocks the best way to plan a retirement strategy?
hmm Yeah, we get asked it a fair bit, and it just in general gets talked about a lot. There's an ardent group of followers for like dividend investing, and I know how the tone of it might come off by the end of it, and I'll just say at the start, like the goal of this isn't to dismiss dividends. They're an important part of your return. But I think that's the key, right? They're part of your return. And I think we'll get into that later in the episode. So I think to start, what is a dividend, and maybe some companies that pay dividends? Like, let's just make sure everybody knows what we're talking about.
Sure. So, what's a dividend? It's a great place to start. And if we think about it conceptually, basically what we're doing is looking at a company and they're earning all this money, a publicly traded company, they're earning all this money, they have their expenses, and at the end of the day, after their revenue comes in and they pay out their expenses, they have money left over, and a company has a choice to make at that point. They can either reinvest the leftover money and try to help their company grow more into the future, or they can issue that money to the owners of the company, the shareholders. With a publicly traded company, that'd be all the stockholders of the company. And then that gets split up among the stockholders as a dividend. So just in case that's a new concept for any of our viewers or listeners, that's what a dividend is. So by nature, if a company is issuing a dividend, then they are probably investing in themselves a little bit less. That makes conceptual sense, right? And if a company doesn't have a dividend, then odds are either they're unprofitable and so unable to make a dividend. That would be the argument for buying dividend stocks is, hey, these are profitable companies. They're doing a good job. Companies I think of with dividends are maybe, and this is not advice to buy any of these specific companies, of course.
Yeah, just examples.
But like Coca-Cola.
Yeah, Johnson & Johnson, I think, has a long history. Procter & Gamble.
Yeah, just kind of staple companies that have been around a long time.
Yeah. No, it's I think that's part of the reason maybe people like it is there's almost this sort of reliability filter, like implied when you look at because these are large established companies. They're usually mature. They've been around for a long time. So the best place for the use of all of their dollars isn't to more R&D or to growth. Like how many Coca-Cola varieties could you like, I don't,
They're trying to test the limits.
A million. Yeah. But at a certain point, it's a return to investors in the form of cash. Now,
right.
There's kind of two big branches, right? You can either reinvest those dividends and buy more shares with them, and then, you have more shares experiencing the future price appreciation and earning more dividend, blah, blah, blah. Or I think in this case, when we're talking about it for retirement strategy, what people are thinking of is taking those dividends as cash and using them as an income stream.
Right.
And that in general, I mean, that whole passive income idea has become a very attractive, thought process for people working and for retarees.
If I may.
Yeah, you may.
Thank you. There are really two primary schools of thought or two groups of people that are attracted to the idea of a dividend only or dividend heavy strategy, in my experience. One is the more old school investor, where back in the day, there was an idea of, okay, I'm just going to have my retirement portfolio and live off the income. Maybe interest rates were higher back in the day, so they could do that with CDs or fixed income. And then you couple that with some dividend paying stocks, and then maybe you don't ever touch the corpus, you just touch the dividends, right? And so that was a popular way to plan retirement back in the day. We think a total return type of strategy can often be a better approach for people. That's one that we often emphasize. But then the other group of people that are very interested in dividend paying stocks are folks watching TikTok a lot and Instagram. And we were looking at a couple of those together the other day, and there were several that would pop up on our feeds that were all about dividends. Buy this one stock, invest $100 a month. In a year, you'll have a bajillion dollars and you'll be getting this many dollars per month passive income, just like it's some sort of guaranteed thing. Because a lot of times when we think income, we think guaranteed. And in investing, there are very, very, very few things that are actually guaranteed, right? Volatility is guaranteed.
Yeah.
And that's about it, unless you start buying insurance contracts. And even then, the guarantee only goes as far as the company.
That's probably a good segue, right, into so, like, that's what dividends are. What are this is probably where we spend the bulk of the time, but kind of the advantages to that strategy, the limitations to that dividend-focused investing strategy, particularly for retirees. So, I mean, I'll start with one. A big advantage, which I think is the first thing you highlighted there, is psychologically, it makes a lot of sense. It's an easy to grasp concept. Like, I have this set of money, it's invested, it spits off this income, I spend the income, but my invested principal remains and it'll carry on. And so that's a genuine bet. It might just be psychological, but like that is a benefit. It's harder, I think, for retirees sometimes to accept the total return strategy because it does require selling some shares. But again, at some point, you have to break from the psychology side and say the math is the math. And if the math favors one side over the other, I might need to try to work through whatever framework I had mentally or psychologically and get to that other side. So some advantages, right? It can be a reliable income stream. Some companies have high dividends for a long time and a long track record of increasing them. But a big point that we'll probably get to is they're not guaranteed. Right? Companies don't have to pay dividends. There's no legal mandate that they return dividends to shareholders, even if they always have.
And in fact, you and I have found, in working with clients through tumultuous market cycles, that some investors that are relying on dividends have less luck receiving them during down markets, right? So I can think of COVID in particular, just anecdotally.
Yeah.
There were headlines coming out during the COVID crisis multiple times that dividend paying stocks were cutting dividends because they didn't know what was going to happen, right? The economy was shut down. This virus is taking over the world. What are we going to do as a company? Maybe now it's not the time to issue this cash to shareholders.
Right.
Well, in a crisis like COVID, where you have stock prices going down dramatically, dividend paying stocks are not immune to that, right? So you still have price volatility. You have the price volatility of the stock market, but you're hoping that it kind of acts like a bond, right? And that's where we start getting into preferred stock. And that's a whole nother.
Yeah. That could be a whole episode, probably.
Yeah, it sure could.
Yeah.
But you're more or less kind of hitching your wagon to a handful of companies. As we mentioned, a lot of these companies have been around for a long time. History suggests it doesn't necessarily matter. At one point, I believe Kodak was the largest, or Polaroid. Polaroid, I think, was the largest company in the world, right? And they're not any longer. I think they went private, if I remember right. And then maybe public again. Let's back up. I don't know enough about that. I used to use that as an example like 15 years ago. So during a crisis, you still have market risk. So dividend paying stocks are still going to move along with the market, right? And so a lot of these companies are historically decent companies to be invested in. It seems like they're names that we all know, but there's no guarantee they're going to keep paying their dividends, and they're not immune to movement during bad times.
Right.
So the question becomes, during bad times, would you rather have a smaller portfolio of a handful of stocks, or maybe a few dozen stocks, or even 100 stocks or something like that all are paying dividends? Like, that's okay. But would you rather have that or a much bigger basket of stocks that include stocks that pay higher dividends and stocks that don't pay high dividends? So maybe we own something like 14,000 stocks in 42 different countries. Now, as an advisor, I look at that portfolio and say, I feel pretty good that this has a nice chance of making it through a downturn. Better than I might if it was a smaller portfolio that was less diversified, even if those companies were paying stocks
Sure.
or paying dividends rather.
Yeah, yeah. COVID is right where my mind went, right? Like for a retiree with that strategy, imagine it's February of 2020 and you retire. Because it's like, when would dividends get cut, even by companies who always paid high dividends? It's during economic instability. So now you have share prices going down and your dividends that you were relying on for income to spend going down or away. You either have to now cut your lifestyle, which I mean, it might be doable for some people, but for a lot of retirees, that starts getting into needs, not just wants. So there's some flexibility. Outside of that, now you have to sell shares like you would have anyways under a total return strategy, but you're selling them at depressed prices. That opens up what could easily be a whole episode or two. I don't want to get overly into it, but sequence of returns risk, right? And that's basically says even if over a whole retirement where you're withdrawing from a portfolio, if you have average returns, let's say, if you have really bad returns in the first couple years as you're withdrawing from it, that can permanently impair that portfolio. That's from a high level, that's what that is. So, right, like imagine you don't know if you're retiring into 2020 or into 2008, or you don't know. So the strategy has to work with that being a possibility. And that's one of the reasons I think this can fall short, right? They aren't guaranteed. Another thing is just the concentration risk. Like you kind of alluded to this, but you end up unintentionally, if you just have a dividend focused strategy, excluding a ton of companies. Amazon didn't pay dividends for, I think, decades, for a long time. That's because they were reinvesting to grow and
Right.
not be an online bookstore, but a place you can have your paper towels show up tomorrow, or you know what I mean? Like the Amazon we know now.
Yeah.
So you would have excluded Amazon, Berkshire for a long time, I think, didn't pay dividends.
Well, and that's, I think, a really valid point is back to the very first example I laid out. Like, what is a dividend? It's a company issuing its profit to its shareholders, right? If we're trying to grow a business, we're probably going to issue less in dividends and reinvest more in the company, right? So theoretically, you might end up making less money overall,
Right.
right? If a company issues 0 to low dividends, but their price goes up quite a bit.
Right.
If you own that stock, you get to ride that price appreciation up.
Right.
So by eliminating companies that don't pay dividends, you're actually potentially eliminating the part of the market that's going to appreciate in price the most because those companies are actively reinvesting in themselves.
Tech is probably the easiest example right now,
Yes.
right? So, and this goes, another point I want to make is the concept of total return, right? And dividends being a part of that. Dividends aren't free money. Like I don't, if you watch a stock and it pays a dividend, usually there's a decrease in share price on the ex dividend date about equal to what the dividend was.
Yeah.
It's not just like, it's kind of like, this is a weird way to think about it, but like if you had $100 bill and you could, I'm not encouraging defacing the currency, FYI, but like if you could tear a little corner off of it that was worth $5 and you put that in your pocket and then you have like $95 here and $5 in your pocket,
Yeah.
you didn't like create $5. You just moved where the value was, so it's like the total return matters. If I get 10% in share price appreciation and 0 in dividends, or I get 8% in share price appreciation and 2% in dividends, those are the total return ends up being in the same place.
Except the taxation element is kind of pivotal here.
That's another limitation that's worth talking about.
If you own those dividend paying stocks in a brokerage account where you're paying tax on activity in the account each year, then a dividend focused strategy can end up being kind of tax inefficient because you receive these dividends as a percentage of the overall return of the total return. Dividends are probably a higher part of that percentage. And so you have to pay tax on that year that you receive it. It's not free money. from a return perspective or a tax perspective. That's income that you are asset generated. Just like if you owned a rent house and it paid you rent, that's an asset that generated income. You have to pay tax on it. Now, the treatment of the tax is probably going to be different than
Sure.
the rental income. But if you instead have a total return focused strategy, where sure, you own companies that are paying dividends or you own funds that are making distributions, and then you also own companies that are growing their net asset value over time. You get to decide when you want to experience the majority of the
Right.
tax impact, because then your tax impact is driven by when you sell.
Right.
And you get to decide that. If I know this year I have a really big tax year, I'm selling my company,
Mhm.
but next year I'm not, then I'm probably going to wait to sell my stock portfolio or some part of it until next year. Whereas if I have a dividend focused strategy and the year I have a big tax event, I'm selling my business, the stock portfolio is uncustomizable at that point.
Yeah.
It's just going to be spitting out dividends and increasing your tax
Yeah,
situation.
yeah, you lose control of timing when you pay your taxes, right? So that's an important point. Um, I don't know where this fits in, but another thing is maybe talk about like the dividend yield because that can be a little misleading because that's how a lot of people will say, how to approach what dividend stocks to invest in is, well, what's their dividend yield? And dividend yield is simple. It's what did they pay in dividends for the year divided by the share price.
Right.
So if they're going to pay $4 in dividends and that's $100 a share, it's a 4% yield. But think about that equation. Um, the dividend yield can go up in a couple ways. One, it can be because the company paid more in dividends, right? And that's how it's always framed. But it could also just be if the share price falls, right? That's the denominator in that equation.
Right.
So if the like sometimes that can lead you to a dividend paying stock that looks attractive, but it's because the company is struggling or has fallen in price. Not always, but the point is, it's like if you look at that one data point and say, well, all these companies have 3, 4, 5% dividend yields. My withdrawal rate's going to be 4%. It'll even out. That not always, and it can be a misleading figure.
You and I are big proponents that investing doesn't necessarily have to be extremely complex, right? There are simple things, simple principles that we can rely on in investing, such as diversification,
Mm,
right? But it doesn't mean that you always have to go for the easiest thing either, right? So, for example, with dividends, I think what a lot of people end up doing is they go on, Yahoo Finance or Google Finance or the Wall Street Journal or whatever, and they see a dividend yield, and then they compare that to what's in their checking account. Well, what's the yield I get on a checking account? What's the yield I get on a CD? And what's this dividend yield? And they kind of treat them the same, right? Well, this one's 3%, this one's 4%, I'll get the 4%.
right.
Those are completely different numbers. Like, they both are percentages, right? But they have totally different I've seen people do this over and over, right? Just compare yield on a CD to yield on a dividend paying stock. Those are totally different universes.
Yeah.
Just because that's an easy comparison to make doesn't make it correct.
Right.
Some easy things are not correct.
Yeah.
It can be simple, but it doesn't mean every simple thing is correct.
Yeah. That's the point here. I think overall is it isn't that this is like all wrong or doesn't have a kernel of truth or when it's talked about online, people are lying in those clips. I think the conversation is usually just incomplete. It focuses on the positives of dividends and of dividend paying stocks, but it just doesn't tell the whole story. And I think particularly if this is focused on for retirees, like for a retirement strategy, the total return is really what matters. Like ultimately, whether you can successfully live the way you want to live throughout retirement and have something left at the end is more driven by the size of your portfolio, obviously how it's invested, but the size of your portfolio and your withdrawal rate ultimately from that portfolio. It isn't gonna hinge on having a certain amount of stocks to pay a certain amount in dividends. I think it more usually comes down to we need overall growth, we need reliable income from the portfolio, but I think total return gives you a little bit more flexibility when you take a total return approach. You have more flexibility with your retirement strategy. You can be more diversified. So I think there just are it's a better way to get to where you want to be. Um, and there's a strategic way to withdraw from principal of a portfolio that doesn't mean over time it might not still appreciate in price. Psychologically, selling feels like spending principal, whereas getting dividends feels like spending a check that showed up in your mailbox. Um, but you've got to move past that psychological point. Dividends are a part of the return. They're not just some separate free money that spits off.
Well, and that's where working with a financial advisor can be so helpful
Mhm.
because we can help you clarify your goals. Why are we trying to, if you come to us saying, I want to live off the income, not the principal, great. Let's talk about why. Oh, it's because you want to pass money on to your kids. That makes total sense. Here's another way that we can do that that might actually be more efficient, right? So it really comes back to what goals are we trying to achieve, and then what investment solutions make the most sense to meet those goals, not necessarily, I heard about this great investment solution. Let's try to shove that into my plan and
Yeah.
hopefully that'll work, right?
Right. Yeah. Yeah. I mean, I think that's the point. Dividends aren't bad. They're a part of the puzzle. They're not the finished image. So, yeah, talk to someone who can figure out a way to incorporate them without forcing you to rely on them, I think is the point.
Awesome.
Yeah.
We'll do this again soon.
Sounds good.